Good afternoon, I'm Brigid Taylor and this is Currency Wars. Let's first take a look at the highlights of the week that's passed. South Africa's current account deficit narrowed to 5.1% of GDP in the fourth quarter of the year. This was revised from a shortfall of 5.8% previously, and that's the smallest deficit to GDP ratio that we've seen in the last 3 quarters. A breakdown of the data showed that import costs were lower on the back of lower energy costs, and that there was a steep climb in the exports, which according to the SARB was really due to the continued recovery in the strike-affected production sector. Meanwhile, CPI for February surprised marginally to the upside with a headline reading of 3.9%. This is after consensus showed 3.8%. However, it was the softest growth in CPI that we've seen since 2011. The FOMC meeting last night in the US saw aggressive slashing of the US GDP growth forecast by the Fed. But we can't rule out that the Fed rate hikes are completely off the table, while there's still appetite for meaningful policy tightening. The slipping in some dovish wording by the Fed has given a boost to the risk sentiment, as was evidenced by the sharp rise in the S&P 500 and the fall in the dollar-rand at the time of the comments last night. It was certainly a significant move technically on behalf of the dollar-rand, with the pair falling below levels seen during trading yesterday of 12.35 to below 11.95 last night, and then closed at around 12.06. Right, now that we've seen the lay of the land, I'd like to welcome my guest today, Eerenstein from RMB and Myes Ndlovu from Prova Trading. So welcome, Myes. It's very nice to have you on the show. Welcome back. And we're going to talk about what's been happening. So it's been a significant week, just because I think we've seen this weakness. We've all been talking about the weakness in the dollar rand. We know what the fundamentals look like, and that FOMC was something that everybody was waiting for. The dovish comments continue. However, they were a little bit more dovish than I think the market had anticipated. So start me off in terms of your feeling around the market. How heavily long is the market in terms of the dollar?
Well, just to kind of talk about the Fed, I think they were slightly more dovish, yes, but it's their dot forecasts that they dropped substantially, and I think that's really what spooked the market. I think the Fed has now moved to more in line to what the market's expecting, and I think that's probably going to remain the status quo. For the Fed to be, it's going to be volatile, and it's going to be watch the data. And if it's strong data, you're going to have dollar strength. If it's weak data, it's going to be dollar weakness. Does
this smack again, though? You know, we saw this in 2013 when there was that initial talk about quantitative easing, and then they started talking about pulling back quantitative easing. We saw this massive move out of emerging markets. The IMF has spoken about the concern with regards to volatility. Do you think that the market's better prepared this time around? Because we've kind of been slowly inaugurated into the fact that the Fed will at some point hike rates in the US. What is your feeling with regards to the sentiment in the market around that Fed rate hike scenario?
Well, I think the Fed makes the wind blow. And everything that we're looking for in the dollar, the dollar dominating the world as we know it, it depends so much on its trend. Even with the South African rand, it's not that the rand is being weak, but it's that fact that the dollar is so strong that it keeps on bouncing and bouncing.
I agree, and I think that that's exactly hitting the nail on the head. We've spoken about this on the show quite recently as well, is saying, you know, we know the South African fundamentals. However, it is really around dollar strength. But yesterday was interesting. It was interesting for me because, you know, we know that the Fed, we've seen the dollar figures. I mean, we've seen the growth forecast. We know that wages aren't keeping up with the job growth that we're seeing. So there are these scenarios that people are concerned about, yet people continue to buy dollars. So we've seen the likes of the US Treasuries galloping. We've seen the US dollar across the entire market. I mean, it doesn't matter where you look. We look at the quantitative easing that continues out of Japan and as well as the Eurozone. They're on the other side of the curve. So that interest rate curve, or certainly the spread between the Eurozone and the US, what are you looking for from a basis perspective? Do you think that that's going to narrow initially, or do you think we're going to continue with that widening bias as we go forward?
No, I think when we look at, so let's just look at straight, you know, would you buy German government bonds at 50 or 60 basis points, or treasuries at 2%? Sure. I think that spread is going to compress and going to continue to compress, because I don't think the ECB is going to be very effective in its quantitative easing. I don't think that money is going to filter down into the real economy, and that's going to prolong the stimulus, and it's going to pose quite a big dilemma for the ECB. Yeah. Whereas the Fed, I think they're going to they're going to raise rates, whether it's September, even June, September, or early next year. I think they will raise rates, and the longer term is the fact that you're going to have dollar strength.
And the pricing curve, what does it look like in terms of the US Treasury? Are the market was talking for, looking at about June, saying that anything after April is possible, pricing in possibility for June. Has that started to extend a little bit?
No, that has.
We?
So we're kind of looking at first quarter next year.
Okay, so we have seen that extend. So that's quite an interesting scenario. And I think maybe just talk us into foreign flows that we're seeing, because that really does speak to the appetite for foreign inflows into the likes of South Africa and other emerging markets in that continued hunt for yield. If we see that US Treasury curve less steep in the shorter end, potentially we can see continuation of foreign inflow. So what is your feeling in terms of the sentiment around the market, seeing that foreign inflow with the dovish rhetoric coming from the Federal Reserve?
Inflation is the mother of all liabilities. So with quantitative easing, it's the number one reason that causes inflation. And because the financial world, as we know it, is at a war zone, it does really affect us, and we don't really have much of control. Like with our rand, we make it grows based on exports because of the commodities and minerals that we have. But then again, we don't have control to international inflows.
Well, that's the thing. We need to create the demand. So if we look at talking about the interest rate differential, do you feel that we're starting to see money? How did the auction go on Tuesday? Just with regards to, because we've seen those outflows recently, right?
No, I think we've seen outflows and it's been for quite a number of weeks now. We'll still see what the foreigners are going to do off the back of the Fed move. Mm-hmm. Yeah, potentially we could see foreign flows coming back into the bond market. But don't forget, we still have a 5.1% current account deficit. Sure. Our fiscal deficit is still a mess. So, that's funding roughly, just on the current account, we have to fund like $193 billion, a billion rand. It's a lot of money.
No, it is a lot of money. And I think that's the concern. The budget spoke to, slightly increasing that. Nothing significant, but we are going to continue to be pricing quite heavily. So you're right. The current account, but one of the things that was a relief is that the export sector has started to pick up with the imports coming down because of the lowering of the oil price. So that balance of, repayments is slowly starting to come in line, certainly not to the levels that we were hoping for, but at least it's moving in the right direction. Do you think this has got legs, or do you think that it's a short-term thing?
Well, I think it's a very short-term thing. I think the improvement in the current account deficit was purely off the back of oil. And yes, if we have oil price continue to drift lower, then granted, it's a little more sustainable.
If rand remains behaved.
Correct.
That's the thing.
But our growth dynamic is still very poor.
Yeah, well, that's the thing.
And that's the thing. We need to have growth in order to remove the structural current account deficit. Otherwise, whether it's 5.1 to 4.9, it's just noise, at the end of the day.
Okay, so talk us through, Myles, maybe your view in terms of the inflation number coming down to 3.8 or 3.9%. That's quite significant because the bottom of the range is 3%. We haven't spoken about numbers in the 3% for as long as I can remember. Yeah. So do you think that's a positive thing, or do you think that reflects on a poor economy with regards to consumers not spending enough? What is your view around that number? Do you think it's a good number, or do you think it reflects on the negative growth rate that we're seeing?
It may seem negative, but it has potential because based on the data that is coming, we're still expecting some growth in that aspect.
Some growth, okay. So the South African economy is, I think it's one of the only economies in Africa that potentially has got growth that's around 2%, whereas most African economies are sitting closer to 4, 5 or 6%, right? Yeah. So if we look at the global growth, a lot of economies looking at the inflation. If we look at the US, we look at the Eurozone, concerned about a deflationary environment. How do you think that's going to play into the hand of the likes of the Fed? Do you think that they're concerned about that?
I think they're very concerned. I think when you look at the strength of the dollar that we've seen, oil prices where they are, both of those factors are very deflationary for the US. And I think that gave the Fed a lot more maneuvering for them to be more dovish. As things progress, I don't see, if the oil price stays where it is, dollar strength will remain there. I think those deflationary forces will still be there. On the other hand, you look at SA, for example, and what do we have? We've got 3.7 or 3.8% headline CPI purely off oil.
Yeah.
But our core inflation is sitting at 5.8 or 5.9%,
Yeah.
which is very close to the top end of the band.
Yeah.
Yeah.
So it tells you that headline CPI will drift higher. I think we've seen the bottom. We've got petrol price increases probably around R2 going in for next month. So the bottom of the CPI we've seen, and it's going to head and converge with core at some point.
Well, then that's the point. I mean, that's maybe why we're seeing that disparity in terms of growth and the inflation number coming down, but growth also deteriorating, is because your core inflation is having an impact on your producers and your manufacturers.
Right.
So let's just lastly, Myles, maybe if you just want to close up the discussion on this week that we've just seen, with regards to the South African scenario, does it still seem as though fundamentally we're being forgiven and we're still predominantly being led by what's happening globally?
Yes, since we all live in South Africa, it means we are long on the rand, and we can expect the best. And I think the best strategy is to sometimes keep a bit intraday, because you never know with the long term how it could affect us.
Okay, so now that we kind of have a good idea of what happened, let's look at where to from here. So the Rand's had quite a significant move. The vols have come in line. Trading overnight, it traded 11.95. So give us your view just with regards to where you think we're going to see Rand and the crosses trade in the next week.
That's a tough one. I think volatility is the name of the game, and we'll see probably dollar rand 12.38, 12 the figure. Euro rand I think is going to be extremely stable. I think we're going to look at it, but I'll tell you 12.95, 13.10.
Okay, awesome. And you, Myles, anything different to that?
Well, I think on the dollar rand it could touch 12.55.
Okay.
Looking at the data that is coming, and I wouldn't comment on the euro and the British pound.
Okay, well, thank you very much. I really appreciate that. So in conclusion, trading strategy for the week ahead, we have seen a bounce in the rand, so take advantage of that if you're an importer. Both our commentators looking for bottoms around that 12 level. There's a technical support at around 12.05, 12.08. However, Myles is a little bit more bearish on the rand in terms of his view, looking for anything between sort of 12.38 up to 12.45. Your euro rand pretty stable, also looking for pretty much around that 13 level. If you need any questions answered, or you'd like to have your questions or comments answered personally, you can get hold of me at Brigid R. Taylor, or you can contact us at CNBC Africa #CurrencyWars410 for your personal responses to the FX markets. Until next week, good luck in the trenches.